Hello guys, welcome once again to Tutorials on the Go. My name is Edmond Jamina and we are continuing our discussion on double entry bookkeeping. We're going to be solving some examples, focusing especially on how to identify which account to debit and which to credit. Number 1, Eliana starts a business and pays in $5,000 as capital. We see that there is a payment of cash, and the payment of cash is in the form of a capital. So we have cash, which is an asset, and capital. Now that we have identified the element, let's look at their movement. We realize that cash is increasing. The business is now $5,000 richer, and capital is also increasing. So once an asset is increasing, we debit the asset, which is the cash account. Then once the capital is also increasing, we credit it. Let's look at the other set of rules. Cash is an asset, and the cash is coming in. So once the cash is coming in, then we debit the cash. Then automatically credits the capital account. The second example, the business buys a car for $1,000 cash. Now, what are the elements in play here? We have car as an asset and cash as an asset. What are their movement? The car is increasing. The cash is reducing because we have exchanged $1,000 worth of cash for a car. So we debit the car account, which is increasing of an asset. Then we credit the cash account where the asset is reducing. Alternatively, we look at the car, which is an asset. The car is coming in, so we debit the car. Then cash, which is an asset, is going out. We credit the cash. Thirdly, they buy goods for resale for $500. When a good or goods are bought for resale, we term that procedure or we term that action purchases. So it means that the elements here are purchases and cash. Now, purchases is an expense account. And if you remember the rules that we talked about, any item of expense is supposed to be debited. So automatically, let's credit the cash account. Or the cash is going out. We lost $500 in exchange for goods. So once an asset is reducing, we credit the cash. Also, cash as an asset is going out of the business. So once an asset is going out, we credit the cash account. Fourth example, they buy more goods for resale for $600 on credit from Mr. A. Now, one thing to note is that once a transaction is done on credit, we have to take note of the creditor's name or the payable's name. The transaction now will be between purchases and the payables account in the name of Mr. A. So purchases, as we stated earlier, is an expense account. All expense accounts are supposed to be debited. Then Mr. A is a payable, which is a liability. Now we have gained an additional payable, or we have increased our liability. So once liability is increasing, we have to credit the payable account where the $600 amount involved. Fifth example, they pay rent for $200 cash. Now rent is an expense account. Every expense account is supposed to be debited. So we debit the rent account, automatically credit the cash account. Let's look at the other rule. Cash is an asset. The asset is going out. Once cash is going out, we have to credit it. So we debit rent here and we credit the cash account with $200. Let's look at the set example. They sell half of the goods for $800 cash. So the element or the account in this transaction will be revenue against cash. Again, if you are not conversant with some of the terms that we are using here, I suggest you visit and read on financial reporting and acquaint yourself with all the elements of the financial statement here, and it will be easier for you to catch up on all the terms that we are using here. So here, any income or revenue account is supposed to be credited. So once being able to determine that the revenue account is supposed to be credited, we automatically debit the cash account. Alternatively, cash as an asset is increasing. We have gained $800 worth of cash. Also, cash as an asset is coming into the business. So we debit cash. Then we credit revenue. Seventh example, they sell the remaining goods on credit for $900 to Mrs. X. As I said earlier, when there is a credit transaction involved, we have to take note of the person. So now, the transaction is going to be between a revenue and a receivable account. A revenue account is supposed to be credited. Then, if you're going to use the shortcut, you automatically debit the receivables account. Let's tackle it from the receivables point now. Receivable as an asset is increasing. We have gained $900 in receivables. So we now debit the receivable account. Number 8, they pay $400 cash on account of the amount owing to Mr. A. So the element in play here would be cash as an asset and Mr. A as a payable. Cash is being lost to defray our debt to Mr. A. Anytime an asset is reducing, we have to credit it. Anytime a liability is reducing, we have to debit it. So we are debiting the payables account in the name of Mr. A, and we are crediting the cash account with a value of $400. The next example, they receive $500 from Mrs. X. Now, Mrs. X is a receivable. She bought goods from us on credit. Now, the element is between cash as an asset and Mrs. X also a receivable as an asset. Now, which one is increasing? Cash of $500 is increasing. Receivable is decreasing. So the cash will be debited as it is increasing. Then the receivable account in the name of Mrs. X will be credited as an asset is being reduced or an asset is going out. The last but not the least example, Eliana withdraws $100 cash from the business. So once an asset is reducing, we would have to credit the cash account, then alternatively debit the drawings account.